Let's move on to a company that probably nobody's ever heard of. This company called Disney. They've had some stumbles lately, and we want to kind of look at the fundamentals of Disney. Their symbol is DIS. They're in the entertainment industry. A lot of activity in the entertainment industry with Warner Brothers and Paramount and Netflix, and I forget everybody. There's so many things going on right now. But Disney has faltered on their stock. So let's take a look at and actually 75% institutional owned, only 1% short on it. PE ratio, not a bad start, 15.2, nothing for the industry, not material. Price of sales is 2 versus 2.1. Price of book value looks good, 1.7, half the industry at 3.4. Price of cash flow, 10.4 for Disney, nothing for the industry. And no PEG ratio for Disney, so that's kind of disappointing. I would like to see a PEG ratio there. Now, over the last year, their earnings are up 151.8%, industry up 102%. That's got to be something to do with accounting or some bad numbers the previous year, because I know Disney's earnings have not grown 150% year over year on a straight line basis, we'll call it. Sales were up 3.4% versus 2.2%. The analysts are not looking forward for good earnings growth on Disney. They're saying a negative 46.6% over the next 5 years. That's their estimate. Industry at 24.3%. I don't know what they're seeing that they think things are going to be so bad for Disney, but that's what they're saying. Dividend yield 1.4%. Gosh, Disney, you could raise this because you're only using 14.5% of your earnings to pay that 1.4% dividend. Let's at least get that up to 2%, I would think. The balance sheet, current ratio, maybe this one, the dividend's not high. It's only 0.7 versus 1.2, so they could be having a liquidity problem. The nice thing, the debt to equity is only 0.4 versus 1.3, but they are absolutely not sitting on a lot of cash and liquid assets that they could use to pay debt if they had to. We do see the net profit margin, 13.1. That's good compared to the industry at 6.9. Return on equity, 11.3. It's not great. Industry's at 20.4. Free cash flow is very good, though. That's $10.1 billion above the industry at $6.4 billion. So I do like seeing that. Jace, what do you got going forward?
Yeah, a couple of things. Number one is on that current ratio. You have to remember Disney is I'm going to call it a travel company as well. Mm-hmm. They do a lot of cruises. They actually just invested, I know, in another cruise. And we held a cruise line in the past. And what happens is when they sell a ticket, that becomes a current liability. So that can distort that current ratio just a little bit.
I mean, and if you're going to look at investing in this company, I think you want to find out how much the cruises account for the revenue of Disney, because they got movies, they still have sports, right?
Yeah, I kind of looked it up here. So entertainment, that's going to include your direct-to-consumer, so your Disney Plus, your Hulu, your linear network, so ABC, your Disney channels, and then some advertising and affiliate fees. That's about $41 billion in 2024 was their revenue there. Then they have a sports division, which is going to be mostly ESPN. They broke those two out. Now ESPN's about $17 billion in revenue in 2024, and then your experiences, that's going to be your parks, your cruises, your resorts. That's about $34 billion, and actually the experiences last year was the most profitable segment of the three.
Really?
Mm-hmm. So
it's expensive going to Disney now. I'm glad
crazy.
You guys are older, but I don't think you can, with a family of 4. I believe if you take a trip to Disney for the day, I think you're going to spend like $1,000.
Oh, probably at least.
Yeah.
I mean, it's gotten crazy, but people are still doing it, and it's a bucket list item for a lot of people. And people that are avid Disney people, they'll still spend it because it's where they want to spend their money.
A couple of years, your girl's going to want to go.
Yeah, still got some time, thankfully, so we'll see. Other thing I was going to say, too, about the dividend, they actually just increased the dividend by about 50%. So there was a dividend increase, but that level you gave is the current level. And the other interesting thing about their dividend, it's not quarterly, it's semi-annual.
Oh, that's not nice.
I mean, it's interesting, but yeah, if you're a long-term investor, it shouldn't necessarily matter. But just something to point out, if you're buying an X dividend, you won't get it in 3 months. It's something that you have to wait every 6 months for.
I think it's Mattel is once a year in October.
There's some that have special dividends, and it looks like pre-COVID Disney's semi-annual dividend was about 88 cents, and now it is going to be 75 cents. So, I mean, they are still short what they were pre-COVID.
Yep.
But numbers for Disney. We look at the current price here, it's $104.28. 52-week range low here, $80.10, and the high, $124.69. This is where things get a little bit interesting for Disney. We go out to September 2027. I see estimated earnings per share of $7.35. That gives us a target sell price of $122.01. So it is above the current level. It is in our hold category, though. It's
Right.
not at our 30% margin of safety. We would need Disney to fall about 10% down to around $93 a share to hit that 30% margin of safety trigger. But where I look here as it being interesting is the earnings growth estimates are pretty strong. I mean, they're looking for earnings growth this year of about 11%, next year 11%, the following year 10%. I know Bob Iger on the conference call talked about multiple years of double-digit earnings growth. I mean, you're getting a reasonable multiple here and double-digit earnings growth with a good brand name. I mean, if this thing did pull back to that 10% level, I'd have a lot of interest in it, I believe.
Yeah, and I'm sitting here. You know, we talked about Wendy's with a lower end consumer. I'm just not sure how the lower end consumer is going to be affected, or Disney be affected by that. I don't know if they, and you know, you see lower end consumer. You never know what that level is as far as income goes. But are they going to Disney? They would go to Disney. That they won't go to the theme parks. You know, these are things you got to kind of consider when you're looking at Disney. I did notice that there's kind of a big range in that 735. There's 25 analysts. The low is 649. The high is $7.87. So it doesn't make me feel really comfortable that that's a good number. It could be a little bit higher. It could be a little bit lower. So I think it's worth watching. As you said, how far away? Because it's in a whole category. I mean,
So it's about what, probably around 18-20% away from its target sell price.
okay, so we'd have to get it.
It's a 10% decline is what we need for the 30% margin of safety.
So, yeah, and I don't know if it's being held up, and they're not in the bidding war with Warner Brothers. I did not see them mentioned.
But I mean, here's where it's great. Netflix's market cap now is over $400 billion,
What is Disney's?
$130 billion.
Wow.
So I just think, I'm sorry, $183 billion. I had 3 in the wrong spot. I think to get a brand name like Disney at that type of multiple is worth that risk potentially of the analyst estimates having that larger variance than we'd normally like to see.
And you point out it is diversified with the cruise lines, the parks. You got the TV. You've got obviously
ESPN.
Mickey Mouse, ESPN. So it's a very good diversified business. It just doesn't seem to be clicking on all cylinders at this point in time.
Which is when you want to buy.
That's right. That's right. But not yet.
Not yet.
Not yet.
Not quite.
You want to put it on the watch
If we can
list.
get a market pullback, I think
Right.
you could see Disney become a very viable opportunity.
And they are on calendar year, correct?
No, they're fiscal basis.
When's their fiscal year over?
So they just actually moved forward. So September.
Oh, September. So they just okay. So because I was thinking, well, after the first of the year, we'll see new numbers, but we won't till
We
September.
just got the new numbers,
Just got
which is why the valuation looks attractive.
better, but still not good to buy. So
Well, it's okay. The whole category is, again, okay.
yeah. You can tell from our kind of hesitation here. We're not like excited about it, but it's worth watching. I think.
I'm excited with the 10% pullback.
Yes, there we go. And you're excited to look at it because again, it's definitely a brand name that is worth considering. But